Directors who prepare for liquidation come out better than the ones who don't. They understand that liquidation isn't failure. It's not about shame. It's about seeing your business for what it truly is and making a decision. And that's how you make sure that your next business, your next chapter is bulletproof. But if you panic, you will give away your power. You'll make emotional decisions and you will sabotage your next chapter before it even begins. I see directors doing this every single week and it's heartbreaking because in most cases, it's avoidable. I had an inquiry last year. Solid business owner, 15 years in retail. He was desperate to make a decision. And I asked him, listen, I think you should just pause for a week. But things got really tough for this guy and he panicked. He shut the doors and he decided to work with another firm. No prep, no paperwork, no checks, no clarity. A few months later, he got a letter saying that he owed them £68,000 personally on an overdrawn director's loan account. He had no idea that was even a thing. The mistake, he reacted instead of preparing and checking. And that's why before you make a single move, you need a game plan, not a reaction, a roadmap. So I'm going to give you 9 steps that will make sure that you walk out of any insolvency in a better position than if you don't do these 9 steps, and hopefully make you ready for your next chapter. So these are the 9 things that you must do before liquidation. Number 1, get your financial records in order, okay? Your records can be a shield. When you enter insolvency, the insolvency practitioner's job is to investigate, okay? They're not going to assume you're guilty, but they're going to check that you've acted responsibly. The clearer your records are, the faster they can do this, right? So basic things like get 12 months of bank statements ready for them, prepare up-to-date management accounts, and get your last set of accounts filed. Now, the most important thing is management information as over your last set of accounts being filed, because your management information, if it's up to date, it gives the insolvency practitioner a clear picture of what's going on. It helps me advise you, but it also helps you understand where you're at. If you've got no management information, you're blind. Try and get all returns in. You know, VAT returns, PAYE returns, corporation tax returns. You know, it's one thing putting your returns in and not paying them. It's another thing altogether not bothering putting your returns in, okay? Have like all your supplier invoices together. Get organised. Exactly what is it you owe? Who do you owe money to, okay? Number 2, and this is a biggie. You need to understand your personal exposure. This is where most directors get blindsided. Personal guarantees and overdrawn directors' loan accounts. Now, let's start with personal guarantees. You might have signed a personal guarantee for a loan, for a credit card, for an overdraft, for a supplier. You might have a personal guarantee on the lease of the premises that you're in. And that might include the dilapidations of the premises, basically meaning you have to return those premises back to the state when you took them, okay? Because personal guarantees, the liability survives liquidation. Now, the first thing you can do is speak to people you suspect you may have a personal guarantee and ask them to send you a copy. Now, even if you've got a personal guarantee, I know this is what worries directors, thinking, right, I'm going to be made homeless. But in 99% of cases, the lender, supplier, landlord that you've signed a personal guarantee with, they do not want to start with bankruptcy proceedings. They would much prefer getting their money back, albeit in some cases over extended periods. Because it's highly likely if you've signed I don't know, 50 grand with Funding Circle, 20 grand with Cap on Tap, and you've got an overdraft with a bank of 30 grand, you're not going to have that money to pay the minute you go into liquidation. Now, when you go into liquidation, everyone you've signed a personal guarantee will let you know. They'll serve notice saying we want that money back. Now, this gives you an opportunity to get round the table with these people. And the easiest thing to do is to say, listen, I'm willing to, let's say you're starting another company. The easiest thing to do is say, right, well, I'll continue the payments, but I'm going to pay them out of a new company. And nearly all of your lenders will bite your hand off at that. Now, that might not be possible if you're starting a new company or you're not starting a new company. And that's at that point you want to try and negotiate an extended period of time to pay these personal guarantees down. Now, if you don't want to do it yourself, I have somebody I've worked with for years and years. I've done a podcast with him, Gary Whitehead. He's very, very good, and he will help you restructure that loan over an extended period of time. Now, with some lenders, if you can raise some money, there's a good chance that some of them will accept full and finals. We had one with iWalker. He owed 130,000 quid. He managed to get £50,000 and he offered iWalker £50,000 and they accepted it. So they writ off 80,000. Now that is not for everybody. It's very much a case-by-case basis, but it's possible. Now, if you owe the banks, I don't know, Lloyds, Santander, Barclays, and you've got an overdraft that's PG'd, or you've got credit cards PG'd, do not panic. They are very, very easy to deal with. And you can restructure those loans over an extended period of time. I've seen people paying back over 10, 15 years. But the key thing is, you need to be prepared and have a plan for what you're going to do around these personal guarantees once your business goes in liquidation. Listen, I want to talk about directors' loan accounts, okay? In particular, overdrawn directors' loan accounts, right? Now, a director's loan is essentially a ledger of when you take money out of the company that's not salaried, or when you put money back into the company. You might have put money into the company to get it off the ground. That goes in as a credit. But the easiest example to explain to people, a lot of directors out there will take £1,000 a month salary through the payroll. And they might take another 3, 4, 5 grand that they call a dividend. Now that's mistake number one, because you can't take a dividend out of a company that is insolvent. And if you are going into insolvency, into liquidation, you are insolvent and you have been insolvent for a period of time. So anything that you take out of that company is a dividend, and then go into, since you become insolvent, remember, insolvency means you can't pay your debts when they fall due. So you could go back to the point where you couldn't pay your debts on time, and that is technically when you became cash flow insolvent. Now, an insolvency practitioner, once they get appointed, will go through the transactions and they will convert any illegal dividends, okay, so basically dividends that were taken when the company was insolvent, and convert it to an overdrawn loan account. This is a big problem. It's the number one problem for directors when it comes to personal liability. Now, what I'm saying to you is you need to understand this before you make a decision. I'm not saying that you understand this and you put off making a decision. That will get you in trouble, right? But what I will do here in my team will help you understand what your overdrawn director's loan account is at this point. And then we'll give you ideas of what type of settlements could be agreed upon once you're in liquidation. Now, there's a number of ways of finding out about your overdrawn loan account. First of all, if you've got up-to-date management information, that is the best way to figure this out, because you'll go on Xero, QuickBooks, Free Agent, Sage, whatever you use, you'll pull a trial balance off, and that balance sheet will show that they'll call it director's current account, they might call it director's advances, it may be in debtors, but it will clearly show what you owe to the company. And that's your starting point. If you don't have management information, or your management information isn't up to date, what you're going to have to do is go back to your last set of accounts as a starting point. Now this is problematic because your last set of accounts was a snapshot of your business on one day in the future. They're about as much use as a chocolate tea cosy to make decisions today. But if that's all you've got, that's all you've got. And you'll go in that last set of accounts and you go, right, directors advance, directors current account, debtors. It'll be somewhere in those accounts and it'll say where your overdrawn director's loan account stands. But that's not all. Because now you've got to work out how much you have taken out of that business since your last set of accounts that's not salaried, not through the payroll, and you've got to add that figure to what you had in your last set of accounts. Now it's not as simple as that. There may be expenses you can claim, your accounts might be really out of date and you wasn't insolvent at that point. But the point I'm making is this is going to cause you a big problem, a director's loan account that's overdrawn. Now, if anything I've said so far has actually thought, flipping heck, I need some help with this, you need to go to that comment section. There is a link, click it. One of my team will call you today, free and independent advice, explaining your options, no strings, no obligations, right? But director's loan accounts and personal guarantees are going to hurt you once you go into insolvency. Because liquidation doesn't necessarily pierce limited liability. It's you doing something that's going to cause you a problem. Listen, number 3, you have got to stop recklessly trading immediately, right? Now the law is clear. Once you know your business can't pay its debts, your duty changes. You're no longer protecting shareholders. You've got to protect creditors. And that means things like don't be taking new deposits if you can't fulfill orders. Don't order stock that you can't pay for. Don't pay one creditor over another. It's called a preference payment and it can be clawed back. Trading on hope might feel heroic, right? I'm going to get through this. Until an insolvency practitioner calls it reckless. You've got to be really, really careful. Now, forgive me, I was off last week with flu. I've still got a bit of a cold. Now, when we're looking at should you stop trading, okay, what you've got to ask yourself is, have you got any hope of recovering this situation? Have you got a big job starting next month? Have you got a load of retentions that come in? Have you got a big invoice that's going to land and is going to sort out these problems? And if you haven't, it is time to shut the doors and take advice immediately. Number 4, before you go into insolvency, it's important that you communicate with creditors, HMRC in particular. And I know it's important, it's tempting sometimes to go silent, to ignore calls, to stop opening letters. But silence will kill the business faster than the debt. HMRC, they control over 40% of winding up petitions, okay? They've got 2,400 new debt enforcement staff and they are knocking on doors more than ever before. So if you owe tax, you need to talk to them. Because if you don't talk to them and you don't talk to the creditors, let them know what's going on, they're just going to go through the debt collection process with you and eventually just going to wind you up. And once you have a winding up petition land on your doorstep, your options are very limited, okay? You've got to avoid it. Now, you need to be realistic with people. I'm not saying ring them and overpromise them, but tell them what's going on. Number 5, protect and support your employees. Listen, your staff do deserve some honesty, that they're scared too. So as soon as you've understood and you've decided what you're going to do, tell them what's happening. Now, what you don't want to be doing is tell them what's happening before you've made a decision on what's happening, okay? So you need to make sure, if you're going through insolvency, make sure things like your wages and your holiday pays are documented, right? Help prepare payroll records. You can guide your staff to the redundancy payment service because they will be able to claim directly from the government. They'll be able to claim statutory redundancy for everyone who's been there over 2 years. They'll be able to claim unpaid wages. They'll be able to claim holiday pay that's accrued and not taken. Just on the statutory redundancy pay, they can claim up to £719 per week. And they can even claim notice pay in lieu of them not being given the correct notice. Now, employees are preferential creditors, okay? And obviously, handling this in the best way, it does protect your reputation, okay? It's important stuff. What we'll do here at Director First is we'll help and guide the employees, okay? We'll also make sure that they've got a dedicated person who they can speak to about the claims. Now, number 6, you've got to separate business and personal finances, right? Directors will blur the lines without realising, especially when things are getting desperate. So stop moving money between accounts, okay? You've got to be prepared. If you're paying personal bills from company funds, that is when the insolvency practitioner is going to classify that payment as on a director's loan. They're going to add it to your director's loan. They're going to ask you to pay it back. Don't be borrowing VAT or PAYE money, okay? So if you've got money stashed aside for the VAT or the PAYE, you can't be taking that money personally. Now, if the company owes you money, you've got to document it, okay? Because once insolvency begins, the insolvency practitioner is going to scrutinise everything, every single transaction. And anything that they see that's personal you've took out of the business, they'll treat it as recoverable. They want that money back. Be careful, okay? 7, keep assets safe and accounted for, okay? This is mega important. When stress hits, directors sometimes move or sell assets to raise cash. And I sort of get that. Excuse me, it is understandable. But it's dangerous because sometimes they're selling assets really, really cheap and they're going to be criticised for it. They're diminishing the balance sheet. Now, you need to list every company asset, every property, every vehicle, all equipment, digital assets. And if you're going through an insolvency and you want to buy some of those assets or you want to sell some of them before you appoint the insolvency practitioner, you've got to get those assets valued. Now, how that protects you is you have an agent basically list out what everything's worth. So if you're going to sell something prior to instructing an insolvency practitioner, you need to make sure you're selling it for a fair market value. You can even buy these assets, but you must be paying a fair market value for it. Now, if you're thinking of selling assets before appointing an insolvency practitioner, you need to speak to somebody. So go into the comment section, click on the link, one of my team will guide you today, and to make sure you don't make any assets, okay? Do not sell assets without fair market value being paid for them. Sometimes you'll be able to get terms to pay for the assets from the insolvency practitioner, but it needs planning, okay? Listen, insolvency isn't always a fire sale. You've got to be careful, okay? Number 8, prepare your statement of affairs. This is probably the single most important document in liquidation. It is a snapshot of your company's financial position that's going to go out to creditors, what it owns, what it owes, and to whom. In this, you're going to include all assets, debts, creditors, and even contingent liabilities. So you've got to make sure the numbers tie to the records. Don't estimate blindly. Be transparent with the insolvency practitioner because the insolvency practitioner will find discrepancies anyway. They are bloodhounds to find problems. And number 9, get independent director advice because here's the reality. An insolvency practitioner doesn't work for you. You need an insolvency practitioner who's licensed to put a business through liquidation. But they are there to advise the company and represent creditors. Their duty is to recover money for them from you in a lot of cases, not to protect you. And that is why independent director advice is critical. An advisor who understands your side, can explain your rights and your responsibilities, will help you prepare for questions from the insolvency practitioner, will help you understand your director's loan account and actually help you negotiate a settlement. We'll also try our best to make sure you understand absolutely every single problem that might hit you as a result of liquidation. Now, the bigger picture. I promise you liquidation isn't a death sentence. It's a turning point. Every failed company leaves behind lessons, and it might be about systems, about pricing, about hiring, about risk, or sometimes it's just simply bad timing. The directors who win long term are the ones who face it, own it and rebuild with clarity. I've seen directors who went through liquidation, launched their next venture debt-free, stress-free and 10 times smarter. They made it a success. They stopped hiding from what went wrong and started building on the things that went right. So before you liquidate, here's your 9-step roadmap. Get your records in order, understand personal exposure, PGs, directors' loan accounts. Don't be continuing to trade recklessly. Communicate with HMRC, tell them what's going on. Protect your employees, separate business and personal finances. Track and safeguard assets. Do not be flogging stuff cheap out the back door. Help prepare your statement of affairs with the insolvency practitioner. And most importantly, get advice that's independent. These steps aren't about saving the company. The company is over. They're about saving you. And if you're a UK director preparing for liquidation, don't go through it blind. Contact us at Director First today. We'll help you prepare. We'll help you protect yourself as much as you can. And we'll make sure that this chapter ends clean so the next one can start stronger. Now listen, I'm really glad that you've watched this video. Now, if you want to find out about how you buy your assets back and start again, everything you need to know about a pre-pack, go there and watch it. Pre-pack liquidation, pre-pack administration, what are the differences, what's suitable to your business. Chris Worden, thanks for your time.